radio program, and coming to you live every Sunday morning at 9 a.m. on the News Radio Orlando network, along with 96.9 The Game. We're also one of the top 25 financial planning podcasts on the World Wide Web. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciary stands ready this week to help you change your life with a successful and cost-effective financial plan that produces superior results and provides you with peace of mind for the future. So, without further ado, here's the chart. See, I'm holding it up and you can't really see it. So now I got to describe it. All right, so this looks at political control and the markets going back to 1926. And it breaks it down based upon the performance that happened when you had certain political scenarios. So, for example, when you had a Republican president and a Democratic Congress, the S&P 500, should have brought these numbers are much smaller than I saw, 6.6%. Should have brought my cheaters. And so, the Republican president, Democratic Congress, 6.6% was the return during that period of time. And then if you have the White House and Congress controlled by the same party, interestingly, you do a little bit better, 11.4% as the annualized return for the S&P 500 during those periods of time where the election split, if you will, is a White House and Congress controlled by the same party. Interestingly, the worst scenario is if you have a Republican president and a split Congress. There, the annualized returns 0.9%. I think part of that skews that data a little bit is that's a combination that history has not seen that much. And then we come to the two scenarios that have produced the best possible return during the particular political combination. And in number two place is a Democratic president and a Republican Congress. 15% is the annualized return for that particular time. And then lastly, we come to actually the number one, meaning the best performing combination of what the market did going back to 1926 versus what the political split was. And here it is. It's a Democratic president and a split Congress. That appears to be the soup that we've got for the next couple of years. We'll see if these numbers hold out. But history tells us, certainly when you look at the chart, right? Then that's the best combination, 15.6%. Hopefully I'm reading those numbers correctly. I didn't realize that when I was preparing for the show earlier today that I think I had my cheaters on. So there you go. Now I don't. Anyway, that's a pretty good combination. So before you throw your hands up, start ringing them too much, understand gridlock is good. And I think based upon the results of this election, you will not see any big significant movement one way or the other, which that level of sort of certainty or lack of uncertainty really helps the economy and businesses to sort of make decisions along the way. Speaking of decisions, you've got some big decisions that you need to be thinking about when it comes to your retirement accounts. The calculus on retirement accounts and what you can do and how you strategize your retirement really got upended earlier this year with the passage of the Secure Act. And we really haven't talked much about this, and I don't think the world is really focused on this issue that much, simply because, you had the pandemic that laid on everybody's doorstep like the next month. And the reality is, of course, that's very much with us. We can all talk about politics and, kind of what the split is and all that. But I think most importantly, let's not forget the reality here is that you still have a pandemic going on. Cases and case numbers are spiking. And I think a lot of what the next administration, the next Congress is going to have to deal with is the fallout or is the play out from that and what you need to do to help, because it's very specific in terms of the sort of the damage that's getting done. It's happening in certain sectors of the economy. Meanwhile, other sectors are doing just fine. It also is impacting traditionally lower wage jobs as well, versus tech jobs or engineering or professional jobs. Those are not as affected during the course of this pandemic. So that's going to be a real issue that the folks in Washington need to wrestle with. Obviously, when the split is this close, Democrats versus Republicans, I think you'll find that what happens winds up being something that might be more middle of the road, because you got to have both sides sort of agree to it. But the Secure Act passed earlier this year, Republican Senate, Democratic House, Republican President, and again, not much analysis on it yet, and I think that's just starting, but we're starting to really see where our traditional advice that we would give people in terms of how to use their assets or what type of assets to use in retirement really gets flipped on its head. And so let me explain where the issue comes from, because it is a significant departure from what had been the rules in place regarding retirement accounts for 25 years, 20 years? I mean, a long time. I mean, it was a pretty established, this notion that if you inherit a retirement account, that you get to spread out the distribution of that retirement account over the course of the rest of your lifetime. So that's pretty significant, right? So if I inherit a $100,000 retirement account and I'm 50, I have to take a certain amount out. Usually it's around 2-3%, but then the rest of it can sit there to grow on a tax deferred, tax compounded basis, which obviously becomes pretty powerful over the course of the rest of my lifetime. If I'm 50 and I inherit it, I'm going to live, good Lord willing, average life expectancy, 50-year-old lives to 80, that's 30 years. That's a tremendous vehicle that you now have that's tax deferred and growing on a compounded basis. And so what the Secure Act did is it eliminated that option altogether. And it basically said, you've got 10 years. You've got 10 years to get all of that money out of the account. And what that in essence does is it certainly accelerates the payment of taxes on that sum of money, and it doesn't allow it to compound on a tax deferred basis for that long of a period of time. So what's interesting on that is that really does have some pretty significant ripples in terms of what the tax implications are on it. And so we think that there are some very specific things that you need to be doing differently. And we're going to talk about 3 or 4 of them and how they might impact everyone in terms of sort of the approach. So when we get back from the break, we're going to take a break. And when we get back from the break, we're going to get into some of the very specific examples that you need to be thinking about as it relates to your retirement account and the new rules under the Secure Act and how to best address them to be tax efficient now, not enough to be just tax efficient for you, but also to be tax efficient across generations. So it's gotten a lot more complicated as a result of the Secure Act. But we'll be back with some examples of some things that you need to be thinking about here, coming up next here on Dollars and Cents with Joel Garris of Nelson Financial Planning on News Radio, WFLA, Orlando. Are the 6 things that you need to know when you're hiring a financial advisor, plus the massive tax increase that was embedded in the Secure Act. Welcome to the program, Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program, coming to you live every Sunday morning on the News Radio Orlando network, along with 96.9 The Game. Also happen to be one of the top 25 financial planning podcasts on the World Wide Web, thanks to an accolade we got earlier this year from the folks at FeedSpot. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciary stands ready this week to help you change your life with a successful and cost-effective financial plan with a focus on providing peace of mind for the future. So before all of that, right, I mean, I would be remiss not to talk about the elephant in the room, or should I say the donkey in the room, if you're go back to those traditional animals reflecting the political parties. And I guess we can all exhale, I think. Some or many out there may be disappointed. Some or many out there may be excited. It's still America. Let's not forget that. That's why this morning we are wearing our American flag tie. And so let's not forget, still the greatest country in the world, where we have a phenomenal political system, phenomenal pamphlet of government in the form of our Constitution that ultimately allows us to have these conversations every 2 years and determine the direction of the country. So wearing the American flag tie, still America, still the greatest place. Plus, looking ahead this week, Veterans Day as well. So wanted to be mindful and take a moment to recognize the veterans out there and the many who served this country to make it what it is today, the greatest on the earth, no question at all. So regardless of where you stand on this election, disappointed, excited, whatever the case may be, I think it's pretty clear you can say we're pretty closely divided in terms of the viewpoint. And I think what that will do over the course of the next couple of years is it will probably lead itself to more partisanship, particularly in the midst of a pandemic, particularly when you look at what happened in the markets this past week, right? So for the week, in case you were too busy watching what was happening on the election side and not really watching the markets, for the week that was, the S&P 500 was up over 7%, the Dow nearly 7%, the NASDAQ, which is generally tech heavy, so all those companies that are doing better in a pandemic world, was up 9%. That was the best week for the market since April and the best election week since 1932. That movement, that upward trend, put the S&P 500 about 2% below where it was in the September high. Also, you saw something that had only happened 3 times going back to 1938, and that was the S&P 500 going up by at least 1% for 4 consecutive days. So a lot of history if you look at the performance of the markets relative to the history books that occurred this past week. And similarly, there's always a lot of explanations whenever the market moves dramatically like we saw this past week. Some of that explanation focused on there being sort of a little bit of a rapid reversal, if you will, and that generated some momentum in the markets as a lot of people expected this to sort of play out much like we saw, particularly here in Florida, like 2000, where you have a protracted fight. Still seems to be some fight still going on, lawsuits and things like that. But I think if you're kind of looking at the numbers and the number of states that involved, it's not like it comes down to just one state like it did in 2000, where it was Florida and whoever won that was going to win. There's a number of states now that are predominantly leaning towards Biden, and you need all of them to kind of switch. And I think the likelihood of that is obviously pretty remote, which is why the AP called the race for Joe Biden yesterday. So a lot of that, though, was that expectation that you might see it play out like 2000. So I think a lot of people were sort of positioning portfolios and trading with that in mind. And so when that didn't happen, then you wind up having to kind of unwind all those trades. And what happens in the market is if you're doing that, then you can kind of fuel a pretty momentum-driven rally, which is certainly what we saw last week. And also, don't forget the economic data, because after all, markets kind of run on economic data. And the economic data that's coming out is actually showing some strong performance in terms of the underlying economy. So we'll give you those statistics. This past week, the unemployment rate dropped to 6.9%. So that's sort of nowhere near 3.5%, which is what it was earlier this year, but certainly seems like that's getting a little under control. The Institute for Supply Manufacturing, which is a manufacturing index that's widely looked at, that rose to 59.3, which was the highest measurement since 2018. New orders, which is also a sort of a forward-looking type of economic piece of data, rose to the highest level in 17 years. And then corporate earnings, which are pretty much kind of wrapped up at this point for the third quarter. There was an expectation that corporate earnings for the third quarter would be about 21% less than where they were a year ago. And in fact, those actually came in at about 7.5% decline, obviously, in the midst of a pandemic, but at the end of the day, not nearly as bad as what we expected. So against that backdrop, the election, markets, what we wound up with, it appears it's somewhat unknown, given that you now have a couple of Senate races in Georgia that appear that are going to go to a runoff. So that'll be a whole lot of money spent in Georgia, that is for sure, particularly when both Senate seats are involved in a runoff. Both of those would have to go on the Democratic side to turn the Senate 50-50. And it's unlikely, I think, that both would go to the D side. And if just one of them goes to the D side, the Republicans pick up the other, then you have a 51-49, which is your very classic divided government. Regardless, I think the message that we all heard in this election is that there really is, sort of almost a 50-50, pretty close. I mean, obviously, you look at the popular vote, you could say it's, 49-47 or 50-48 or whatever those numbers came out at. The reality is that I think the message of what the Democrats were expecting, this big blue wave, things like that, certainly didn't materialize. They wound up losing seats in the House. Senate, again, looks like it probably will be just barely Republican. That is the classic definition of divided government. And that gets us to the old market adage, right? So not to completely borrow Michael Douglas's greed is good expression, but when it comes to the markets and politics, gridlock is good, right? How good? Well, we've got a pretty interesting chart, and we're going to get into that chart and talk about it with our listening audience after we return from the break. So we've got some good numbers in this chart, numbers that go back to 1926, and kind of look at what happens if you got an R in the White House, a D in the White House, a split Congress, or any of those kinds of factors. And so stay tuned through the break, because it's got a pretty interesting conclusion. We may, in fact, have wound up with the best possible combination from a historical basis for market performance and politics. We'll talk about that when we return here on Dollars and Cents. The Secure Act was the biggest tax increase on your retirement dollars. And really, we've yet to see the impact play out, but what we're already seeing is a change in strategy, really, in terms of how you use your retirement assets and how you think about those retirement assets, particularly as you look across the generations that ultimately are going to inherit those assets. So we've got some very specific examples that we want to share with you on the program today in terms of how to sort of address or deal with this latest change that happened earlier this year. So welcome to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program, coming to you here Sunday mornings at 9 a.m. on the News Radio WFLA Orlando network, along with 96.9 The Game. Also happen to be one of the top 25 financial planning podcasts on the World Wide Web. So make sure you connect with us over on any of our social media platforms. If you can't find us simply by searching for Nelson Financial Planning, go to our website, nelsonfinancialplanning.com. Upper right-hand corner, you'll see a bunch of icons. Click on the one that looks familiar to you, and you'll get connected. You may want to do that, particularly with YouTube, seeing how we were talking about a little chart in our prior segment. If you're a client of the firm, you're going to get that chart this week. It basically details since 1926 what's happened based upon political splits and the market. Interestingly, best number, is the split that it appears that we will wind up with: a Democratic White House and a split Congress. Obviously pending the races in Georgia on that, but yes, that's still to be decided. But it looks like we're certainly heading in that direction. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where our team of certified financial fiduciary stands ready this week to help you change your life with a successful and cost-effective financial plan that produces superior investment results and provides you with peace of mind for the future. So there's a lot of ways in which you need to be thinking about your retirement accounts differently, right? Previously, the old rule, the stretch IRA rule, which was around for 20, 25 years, your beneficiaries were allowed to take that money out over the rest of their lifetime. Talk about a tremendous feature or a tremendous power of tax-deferred compounding that was left behind to the next generations. Now, all of that gone, G-O-N-E, gone. The Secure Act replaced it with a 10-year rule. And here's the reality of it. This generation that over the course of the next 20 years will pass their assets to the next generation, the majority of those assets are going to be retirement account assets. This current generation that is in sort of that 65 to 85 year window is the first generation where retirement account assets were the main asset. And so we haven't seen that massive transfer of wealth on a retirement account basis. And unfortunately now with the Secure Act and the 10-year rule, you really need to start thinking about how to do things a little differently. And the first is sort of the scenario we actually saw play out in a conversation last week. And it was a conversation of, okay, well, how do we pay for cost of care when it comes to medical expenses? And the traditional rule of thumb approach would say, okay, well, in order to keep your taxes low, then let's take it out of your trust account or your after-tax account, your non-qualified account, and let's leave the IRA there because, hey, that's going to pass to the next generation. Well, the changes in the Secure Act really sort of flipped that on its head, whereby now we found ourselves actually recommending, well, wait a minute, we know your kids. They're both doing great. Actually, already retired, so they're from a wealth perspective, they're doing fine. From an income perspective, they're doing fine. We may not want to push that level of taxation to them to have them have to pay the taxes at those higher rates. Instead, let's really look at using more of your retirement account now because your tax bracket is in fact lower. So it really gets you into almost like an intergenerational planning approach where you're looking not just at your tax rate, but also what the kids' tax rate looks like, assuming that you're leaving your retirement accounts to your kids. You may be saying, maybe not, or you may not have kids, so that obviously is a very different scenario. But to the extent you're leaving them to kids or next generation, the notion of sort of looking at, well, wait a minute, Johnny's taxes, he's doing pretty well and he's making a couple $100,000 a year. That's a much higher tax bracket than me, that I'm, retired and just collecting Social Security, taking my required minimum distribution, things like that. So it really does get into a much deeper conversation than sort of the lockstep, oh, take it out of the retirement account or take it out of the non-retirement account because then you're going to be able to save taxes. So it really almost gets you into the concept of almost a family income tax efficiency planning strategy. And that's a lot of words, but basically it means, hey, check out everybody's tax rate and see who's in lower ones. You may want to be taking more out of your retirement account if you're in a lower tax bracket than your kids. Similarly, the same thing if you think back to sort of the medical expenses where traditionally you might say, okay, I'm going to take those out of an after-tax account. The reality is that you may want to take them out of a retirement account to bleed down the retirement account as much as possible. Don't forget that if you are paying a lot of money for care, then medical expenses are deductible. If you're paying a lot for care, then you may very well be above the threshold to be able to deduct those medical expenses. And then you would be able to sort of offset, hey, I'm taking money out of my retirement account, that's ordinary income, but I've got the write-off of medical expenses. So those would sort of cross each other out. And then that would also then lead you to taking more proportionally out of perhaps the retirement account than you might otherwise have. Another trick, which we've certainly talked about before on the program, which I think is going to be an even more powerful option for people, is this notion of a qualified charitable distribution. That allows you to take your required minimum distribution, send it direct to charity, and then you don't have to report that portion of your required minimum distribution as income on your tax return. I think the QCD, the qualified charitable distribution option, is one that you're going to want to be taking more advantage of, again, to potentially pull down the balance that's in the retirement accounts. Another thought to be thinking about in terms of this new landscape under the Secure Act is Roths. And what's interesting is, I remember 20 odd years ago, we were certainly always been more fans of the traditional approach, but I think now, particularly with tax rates where they are, and with the Secure Act, that Roth piece may be getting more on the table than any other time that we've seen it. Understand that if you do a conversion to the Roth, the Secure Act still applies that 10-year payout rule, but because it's Roth money, it comes to your beneficiaries without taxes. So needless to say, the notion of using a Roth becomes potentially more important and more lucrative, particularly if you start to kind of look at this intergenerational tax efficiency strategy that you've now got to apply on your retirement accounts. When we talk Roth conversion, remember my two standard caveats as it relates to Roth conversions. Number one, make sure you got the money to pay for it, because you can't undo it anymore. That rule has gone away. And then number two, make sure you are understanding the ripple effect that can happen on your tax return. You really should do a full tax projection, an actual tax projection with software, with spreadsheet, that kind of detailed projection that really helps to see where those ripples might be on any type of a Roth conversion, because they can pop up anywhere, places that you might not think. Having more of your Social Security tax, things like that, all of that can lead to a much different tax outcome than what you might expect. And then on that same impact, I think sort of the backdoor Roth strategy, whereby you're not income eligible to do a Roth contribution, but you put an IRA, you do an IRA, you have it as a non-deductible contribution, then you immediately convert it over to a Roth, so there's no real tax implications when you do that. That's a pretty intricate and detailed strategy, but one that I think may become more powerful, particularly against this changed landscape as a result of the Secure Act. So just some of the things that I think you need to consider given that change of landscape. We're going to take a break. When we get back, we're going to talk about some of the things that you need to be thinking about when hiring a financial advisor. Coming up next here on Dollars and Cents with Joel Garris of Nelson Financial Planning on News Radio, WFLA, Orlando. Current financial landscape, as we've said many times on this program before, is filled with an alphabet soup of names: financial planners, financial advisors, investment managers. I mean, it's soup. Now, how they charge is also a soup as well. There's fee only, there's commission, there's management fees, there's asset management fees, there's investment expenses. I mean, it's just a soup that's about as clear as pea soup. So on this segment of the program, we're going to talk to you about the 6 things that you need to be aware of, sort of like a 6-step checklist when using them to hire a financial advisor. And so what we ultimately see, though, is that a lot of folks are overpaying for underperforming financial advice. So the point of these 6 things is to help you avoid doing just that. Don't get hung up on labels. Don't get hung up on how something gets paid. ultimately look at these 6 different things that we're going to share with you in this segment of the program. So welcome back to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program, also one of the top 25 financial planning podcasts on the World Wide Web. My name is Joel Garris, certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a successful and cost-effective financial plan that produces superior investment results and provides you with peace of mind for the future. So what are those 6 things that you need to be aware of and ask, or sort of, kind of have a little checklist when you're looking at hiring a financial advisor? And so it starts, of course, number 1, with making sure that they are a fiduciary. And understand what that means is, by definition, a fiduciary is someone who is ethically bound to act in another's best interest, right? So this helps obviously to eliminate sort of conflicts of interest. This helps to eliminate sort of hidden expenses and fees and compensation that's getting paid that is in a less than transparent matter. So how do you know if they're a fiduciary? Well, ask. If you get a sort of a hedged answer or something like that, then they're probably not it. There are basically 2 credentials in the business that give rise to sort of that fiduciary standard. There's a certified financial planner, and then of course there is the newest one, the certified financial fiduciary, which is sort of the highest level of a pure fiduciary designation that exists out there in the world today. Our entire team, for example, at Nelson Financial Planning, are certified financial fiduciaries, as we say sort of in that intro part. So number 1, ask that question. Make sure they are a fiduciary. Make sure they've got the credential to back it up. If they just say that they are fiduciary, but they don't really have a credential or requirement that really obligates them to do that, that they voluntarily sort of assumed, then you may want to move on. Number 2, don't hire the first person you sit with. I mean, just don't do that. You know, much like if you were having a diagnosis from a doctor, you would sort of seek out a different opinion. You should do the same thing when it comes to financial advice. We recommend that you talk with at least 3 people and go around and interview them, and use these 6 things that we're sharing with you on the program today as sort of a little bit of a checklist in terms of how to ultimately interview whoever it is that you're speaking with. So certainly you want to go ahead and interview 2, 3, 4. Certainly don't hire the first one that you come to. Much like you'd want a second opinion on something medically related, you certainly do want to kind of see what's out there in terms of the current philosophies and approaches that are out there, which gets us directly to the third thing is, don't choose an advisor with sort of the wrong specialty or one who is lacking expertise on a particular answer. I'll give you some examples of that. There's a lot of folks out there that really focus on retirement plans like 401ks, 403bs, things like that, or government plans like 457s. Obviously, that's their area of focus. That's their area of specialty. So they may not be as big of an expert on generating out retirement income or estate planning. Another area where we see people focusing is on sort of high net worth clients, right? I mean, you hear these ads all the time. If you can only schedule an appointment with us if you've got over 500,000 of assets. So ask that specialty question as well, because the reality is that a lot of firms don't stand by the tax advice that they give, because if you look at the statements, it has that little disclaimer, please consult your tax advisor. Well, I think you want your financial advisor to also be willing to give you tax advice that you can rely on and not, fall into a little sentence disclaimer on it. That's why, for example, like on our team, we have not just an individual who's an IRS enrolled agent, and also a certified financial fiduciary, but we also have someone who's a CPA and also a certified financial fiduciary. So understand that they've got to make sure that they've got the specialty in terms of what you're looking to have them do, but also the specialty in terms of the level of expertise that they have as well as part of their overall approach. And then, number 4 on this list is talk about the investment strategy. Look, everybody's got a different investment strategy out there in the world at large. And you want to ask that question. The reason you want to ask that question is, look, there are folks out there that think that annuities are the single best thing to have in your investment portfolio. Obviously, we don't, because we talk about that all the time on the program. But those are the kinds of things that you want to ask. Some people prefer to be bond heavy. Some people prefer to be cash heavy. When you ask that question about investment philosophy, they should be able to tell you in a few sentences exactly what it is. Ours, for example, is that we focus on actively managed funds that have long-term track records of producing superior investment results that ultimately focus on those large companies that make the stuff that the world uses every day. And so that's the investment philosophy. Folks should be able to answer that as well. Real quick, last 2, check the credentials and ask them how they get paid. We may even double back and talk a little bit more about that on next week's program, but we got to get out of here, so we will wrap it on up. This is Dollars and Cents with Joel Garris of Nelson Financial Planning.